Good morning and thank you for joining us for our August webinar episode, an episode we're excited to dive deeper into the objective-based investment approach of Morningstar Investment Management and have a good look at performance, current outlook and resultant portfolio positionings. My name is Julian Pitt and today delighted to be joined by Bryce Anderson, who I'll introduce more formally shortly, but before we get underway, I need to undertake a little housekeeping. Information in today's webinar is general in nature and should not be construed as personal advice. CPD points will be issued to those, will be issued to those who see out the duration of the 45-minute update. The webinar is being recorded for those who are unable to make this time. And if you have any questions throughout, please type them into the question asking area and we'll endeavour to get to them all as we go through. Just a quick update from my perspective. Some of you may be aware that since Angus Benbow's joined the organisation a number of months ago, Centrepoint's undertaken a strategic refresh. Something that has been across the full breadth and depth of the business with full employee engagement, which has been a really invigorating and energising experience, really ultimately to help identify the areas that we can better serve advice firms. So that one has been ongoing for a number of months now. We've got the Angus's market announcement tomorrow, so make sure you dial into that as well to understand a little bit more, and we'll be a little bit more forthcoming around what all of the different elements bring together for you shortly. But there's been a tremendous amount of work, I guess, delivered into that stream, so we appreciate all the patience throughout. VMAPS has had a few recent feature releases. So a little while ago we had fee aggregation, we had the administration fee capping. We've recently seen the release of super pension components, the visibility of those for advisors, and more recently we'll be announcing or getting out in email shortly that Centrelink schedules are now available in the advisor portal. So some great additional news there. We'll get an email out to that end very shortly. Also, recently, on the 31st of this month, Morningstar will cease managing the assets of the 4 sector models, 2 Australian equity models, property and cash. You should all be familiar with that. The 2 Aussie equity models we linked to, or we will be linking on the 31st of August, any remaining monies in those models to the Benelong model. So if you have any questions about that, we've got a bit on our website. Feel free to call us if you don't have that email already. Then I'll hand over to Bryce now, and then at the end we'll also have a little time on what is next for VMAPS and Ventura. So Bryce has not presented in this forum before, so I'll spend a little bit of time on his bio and we'll shorten it up for next time. But Bryce, welcome, firstly. Thank you. Portfolio Manager for Morningstar Investment Management, MultiAsset Portfolios. Bachelor of Applied Science, Exercise and Sports Science. So well-rounded individual, as well as Masters of Commerce, Finance and Funds Management and CFA Charter holder. Been with Morningstar since July 2015, responsibilities including capital market research, investment strategy, portfolio construction, management to achieve competitive investment returns and better outcomes for investors. Bryce has over 9 years experience in financial services, previously at IAG Asset Management, responsible for manager selection, due diligence across asset classes. He's a member of the Asset Allocation Subcommittee, Portfolio Construction Subcommittee and Manager and Security Selection Subcommittee. And we've talked about your credentials there. Welcome, Bryce.
Thank you very much.
Now, we haven't had too much to do with each other in the past, but by all reports, excellent human and individual. So you come highly recommended from your peers within Morningstar. So thank you for joining us. And you join us at an interesting time. By all reports, many reports, the market seemed to be seeing a late cycle growth-led market, which really hasn't helped performance. We've seen some very strong absolute performance returns across the board over the last quarter, but you really have to be in the right places. So just a few call-outs. Australian equities delivered nearly 8% for the quarter, incredibly strong, but then emerging markets was minus 4.5%. And value versus growth stocks have diverged pretty much globally as well. So we've also got the trade and geopolitical tensions, the currency movement. So there's a lot going on in the world, and hoping that you'll be able to, I guess, shine a bit of a spotlight on where you guys see things.
Sure. Yeah, so once again, thanks for having me for this update. So I'll give you a bit of a high-level agenda in terms of what I'm going to go through. But I think, as Julian said before, if you have questions, please enter them through the chat, and we'll endeavour to get to them, because I guess the more interactive this is, and if we get, the more you can get out of this, given there's issues, I'm sure, at the back of your mind that you want answered. So as far as the agenda goes, so I'll go through just a quick market update in terms of performance, and then move on to what that means for the what that has meant for the managed account performance, and then I guess dig a bit deeper into some of that that detail around the current market environment. So the green is back, so US dollar strength, and I guess the fallout from that. Some of what Julian touched on just previously, so feast and famine. There's definitely, whilst headline returns have been quite strong, if you look at a sort of a misty world, underneath the bonnet, there's quite divergent performance. And then from that, look at, I guess, where that rubber hits the road, and in terms of the process, and we're a multi-asset house, we're valuation-based asset allocators. So where the rubber hits the road is what our forward-looking expectations of returns are, and where we see the value in the world, given everything that's happening. And then finally go into some of the rebalancing activity that is happening in portfolios, and where the portfolios sit from here. And then I might just provide a bit of flavour on what you're likely to expect from us from here, and then finally just wrap up. So with that, I might just dive into the market update on slide 3. So what we have here are different asset classes, and what they're ranked here is by the yellow bar, so the 1-year number. And I'll probably generally mostly talk to that 1-year number, but for your own reference, there's the quarter number, the 3-year and the 5-year, to look at those more long-term results. So if you look at the 1-year number, I think ranked from best to worst there. So international equities unhedged is has been the leading performer amongst all asset classes, and that tells a couple of stories there, which I'll get back to. And then Australian equities, Australian property have also been strong. And then you see fourth down the list, the international shares hedged. And then down the right-hand side is probably more the defensive assets. And as you'd expect, they've delivered in absolute returns lower returns than you have your risk assets. And that's generally over a full market cycle, what you would expect. But if we just unpack a bit of the returns in that international shares unhedged number, I think whilst that is in absolute terms, that's a pretty strong market. Underneath the bonnet there has been some really divergent performance. So what's done really well is pretty narrow. So those US IT stocks have really driven a lot of that international shares performance. And then within that, on the other side, you've had EM, which has had quite a topsy-turvy time, particularly in the recent quarter, where it has fallen in the midst of a lot of geopolitical concerns and some concerns around particular markets like Turkey, etc. And then the other thing that runs through all of this is if you compare and contrast the unhedged return of international shares with the hedged return of international shares, and there's actually quite a big difference there. And what is driving that is a lot of the weakness in the Australian dollar against, in particular, the US dollar, which has been pretty pervasive in markets across the board. So the US dollar strength. So when the US dollar is strong or when the Aussie is weak, that unhedged return will benefit because you're translating back into Aussie dollars. So that's what I pull out there before looking, I guess, into the performance of the managed accounts, which sort of brings to light some of those key issues that we talked about there. So over onto slide 4, and across the multi-asset managed accounts, and you can see at the top the names of the different managed accounts as well as the objective and the time horizon. And what we've got is the quarter, 1 year, 3 and 5 year number. And I guess as the numbers we like to hang our hats on here are the 3 and 5 year numbers. And with what would say there is probably the 5 year number looks good to us, but the one we're probably quite disappointed with is the 3 year number. So whilst a couple of those are hitting the objectives, there's a few that are just slightly lagging over that three year period, and that's something that we're disappointed in. But I don't think that over the long term that's going to hurt our ability to hit those objectives. So we're still confident of hitting those objectives. If you look at the more short-term performance, so the 1 year numbers and in fact the quarterly numbers, so over a shorter time period, we don't think we have much ability to forecast over the next year where markets are going, and so those numbers in the short term are sort of more of an outcome of us trying to allocate capital accordingly. And in the short term, markets could do a lot of things, but in the long term, we think that that's where we can truly add the value. And in the short term, that noise is an opportunity for us. And what probably also jumps off the page here is that all growth number, so over the quarter. And there's a couple of things in that. So that portfolio has changed to an SAA objective. So in that benchmark is a lot of US equities. So with US equities having done so extraordinarily well because of that IT and that growth, a lot of growth momentum, that has what has been the driver of that underperformance. And because we don't have a lot of exposure to the US, our exposure in international equities is in emerging markets, Japan and Europe are where we see the opportunities in terms of for investors. So,
and the allocation of the Australian equities within that portfolio would have been tilted away from the miners who did incredibly well for the quarter.
Correct.
It was just a confluence of
I think that's what we talk about, I guess, internally, is that this quarter has been just a combination of a lot of our high conviction ideas, whether that be at the stock level or at the asset allocation level, which have underperformed, as I guess on the other side, the more expensive parts of the market, and this is true of the US, it's true of Australia, have continued to rally. So it's been of what you have held as well as what we haven't held as well.
We'll have a look at the sectors later, but why, if you believe markets are expensive, why do you think they're getting more expensive?
I think it's one of what you've seen in the markets for some time is that people have been willing to pay anything for anything with growth embedded in it. So in a low returning environment, people have paid up, whether that's Australia or globally, for stocks that have growth. So think of Facebook, think of Netflix. And in a short term, that could continue. But I think one thing that I'd pull out is something like Facebook, and it's a bit of the danger you have in being in those expensive names is that don't get me wrong, Facebook's a great business, but not in our eyes, not a great investment. So and you've seen when they deliver results, they delivered their update to the market, and they delivered what growth that most companies would dream of, but it wasn't what their market expected, and Facebook created. And that's the danger of being in those high multiple names, is when they miss their earnings expectations. They don't fall by 2 and 3%; they fall by 20.
And on that particular day or overnight, that fell by the largest amount by market cap of any stock in history.
Correct.
Yeah, it's phenomenal.
So I think that's the danger, and the way we invest, we're more value based, and so we'll be in positions, be it at the asset class level or at the stock level, that everyone hates.
Yeah.
And to be honest, you make quite a lot of money when people go from hating something to just disliking it.
Yeah.
And you've seen that recently with something like Telstra.
Mm-hmm.
So whilst Telstra has been a drag on performance for our portfolio, as you say, and QBE as well.
Yeah. Well,
you've seen two names
over because they're some of the names here.
Good segue into the 3 month. This is just the 3 month contributors and detractors to the portfolio. So on the left hand side, what a key theme here up the top is anything with a bit of US dollar exposure. So those names, so the global real estate ETF at the top, that global healthcare, as well as the Morningstar International Share Fund has international equities, but also it's that unhedged US dollar exposure. And then on the flip side, for the quarter, you've got Telstra, emerging markets, Brambles, AMP's a bit of a different story.
Yeah.
But those ones, Telstra and Brambles in particular, if we look at what's happened since the end of the quarter, so Telstra is a prime example where that's probably, I would characterise Telstra as a business which has plenty of challenges around it. So I'm not saying that Telstra is a fantastic business, but it's in our eyes quite a good investment because there's so much negative news baked in.
Yeah.
And when they updated the market with their results last week, what you saw was that they released a reasonably clean set of numbers, and it re-rated 6% on the day. Same with QBE.
Yeah.
QBE has been notorious for delivering messy results with write-downs across all their businesses, but they delivered a clean set of numbers with not much noise.
Yeah.
And the market rewarded the stock. It was up again 6.5% on the day or thereabouts. So those are the type of names, be it at the asset class level or at the stock level, that will be in those sort of controversial names. And you've seen with Telstra, Brambles, QBE are three names which have re-rated quite a lot.
And so it seems to be you can't catch the falling knife. So you can't, if the stock's fallen, you can't absolutely pick the bottom. If that seems to turn around, the market or flattens, the market rewards it for not falling further.
Yeah.
But the growth ones, if they don't maintain their momentum, they get slammed.
Exactly. Yeah. And I think a part of it comes back to like investor psychology, in that you have people hate losses, and often it's in the things that have fallen where there's so much negativity, whereas in something that's delivering, it has the opposite effect. Everyone loves it, everyone can continue to pile in, it has so much good news baked into it.
Yeah.
That if Facebook had expectations of 30% earnings growth, which is amazing, and delivers 20%, the market will hate that.
Yeah. And I guess being a value investor, that's your lot in life, isn't it?
Yeah,
You've got to enjoy the bad news occasionally.
Exactly. And I think what happens during these where your positions fall is you have to continue to build into these positions and take advantage of what we think is short-term noise, really.
But surely challenge them as well. So emerging markets, we've got Trump out there banging his fist and really creating some tension through trade.
Yep.
He's calling out currency manipulators. What's happened in Turkey although it's only about 1% of emerging markets, I think by market cap, it does sort of flow through into some markets as recently as Brazil, I think. Yeah. So does that offer you the opportunity to review your conviction on EM and decide whether to double down? And
so I think that the way, there's many levels to this, but I think the way we take this out, and I'll get into this a bit later, is that we have a assumptions around our emerging markets, forward-looking expectations, and when things drop, we challenge those expectations.
Yeah.
And say, well, does this still hold? Does this still hold?
Yeah. Yeah.
And that's a really disciplined way that you should do for managing portfolios. And I think to go to the stock level, an example where we challenged our expectations was with AMP.
Yeah, great.
So AMP, you'd have to be living under a rock not to have seen what's happened with AMP, what happened at the Royal Commission. And I think to us, what we saw was we didn't expect what came out of the Royal Commission.
Yeah.
And we'll put our hands up. And out of the back of the Royal Commission, what we see for AMP is, I think, the range of outcomes increase. That was too big for us in terms of, and we thought that we were better allocating capital to other names such as QBE and Telstra, where we had a lot more confidence in. And so we just, that's where it's not just chasing good money after bad. It's like, well, reassessing, going, well, the thesis has changed here, and then act accordingly.
Great. Good examples. Thank you.
So that's
anything to call out on the 12-month numbers next?
So I think 12-month numbers. So I think whilst emerging markets was on the right-hand side in the short term on the detractors, it's actually been a bit of a round trip for emerging markets. Like, it has been a strong performer, and on the way up at the early part of this year, we were trimming emerging markets because we're realising that value. And all things being equal, if it's fallen, which it has done in the last quarter, that's an opportunity to increase that. So you can see there on the left-hand side, there's some of our higher conviction positions, so emerging markets, Japan and Europe, over the 1 year have contributed. And then on the right-hand side, I think it's probably safe to say over that 1 year, the stock names in the Aussie equities portfolios have struggled, but I think encouragingly, I think we've made a lot of that back just through this reporting period. I think you've had most of those names have reported well. Coca-Cola's out today. It looks like on first glance, pretty strong set of numbers. So these things have turned around, and as these have fallen, we've built into those positions.
Beautiful. And the multi-asset real return on the left there, halfway down, seems to be doing what it's meant to do.
So I guess what that multi-asset real return fund is there for, it's what we define as our alternatives exposure. So it has the hedge funds in there, and it has the alternative managers, but it also has the really, purest form of our ideas. So it has not only the headline Europe exposure, but it has going underneath the bonnet, and we prefer things like telcos, financials and energy within Europe. So that has the ability to really focus here on those opportunities.
Oh, it's going well, good. And that was brought into the portfolio, I think, about 8 or so months ago.
Yeah, correct.
Oh, that's great.
So with that, I'll go on to just some of those key things, and Julian raised a few before around what's happening in the current environment, what we're seeing. And I guess and I've mentioned this as well, is that over this quarter, it's been an amazing period for the US dollar. So it's not just against the Australian dollar, but just against global counterparts. And I guess there's a bit of cause and effect with the US dollar. So when there is, I guess, global volatility, you get a bit of drawback to safety, and the US dollar is a bit of that, plus what's happening with yields in the US. So yields in the US they've come back a bit recently, but their yields are increasing in the US, so that draws capital back to the US. But I think that there's clearly the global trade wars and jockeying is a key issue for markets. And I think it's an interesting one. And I think what Trump is doing, and he is appealing to his voter base who got him into power. So he is trying to
America first.
He's trying to make them feel as though he is going into bat for them and doing what they doing what they put him into power for, and in a way, it doesn't actually matter if there's any impact of what he's doing. It's just what his constituents feel.
Yeah.
And interestingly, I was in the US a few months ago and did a focus group within one of Trump's sort of swing states, so in Cleveland. And regardless, he's pretty much achieved very little in the last, since he's been in power. But when you talk to these people and you hear what they say, it is incredible that they actually feel like their lot in life's better, that Trump's doing all this stuff for them, yet in reality, there's not much actually happening.
They're watching Fox News.
Yeah, exactly. And that's his conduit to get to his and tweeting his conduit to people who voted for him. So, but the trade wars, the jockeying for that has just flowed through to the US dollar, and that has also flown into.
And you're going to talk about emerging markets in a second, but just while we're on this slide, so potentially it flows through to emerging markets. Some of that's through Europe. The ECB may, or people may not be increasing rates on a path that they expected, which means that US will be increasing solo, meaning US dollar could potentially keep pushing higher.
Potentially, I think generally, if you look at central banks around the world, I think the take-home message is that central banks are taking liquidity out of the system.
Yeah.
So definitely the US, the ECB, and even Japan are sort of slowing the growth of their balance sheet. So I guess the easy money just flowing to markets is not continually going to be there. So I think, to your point, so there could be added US dollar strength, but it's all about, in a way, the opportunity that presents. Like for an Australian investor, it's actually having, like, we have quite a bit of, from a portfolio diversifier point of view, we have quite a lot of US exposure. So because Australia is seen as a risk currency, when you have bouts of this in a portfolio sense, having some US dollar exposure really helps, as does having yen exposure. So I'll flick over onto slide 9, and so it's a bit of cause and effect here. So EM, this shows just the relative performance. So if it's trending down, this means that emerging markets has underperformed, and if it's trending up, that means that emerging markets has outperformed developed markets. And I guess since the GFC, you've had a period whereby, since that sort of shaded out period where EM markets have underperformed, and I guess there's a story in that around from where we started building our exposure. And sort of we started building our exposure in emerging markets sort of in that sort of 2013-14 period. And as with many things, you get many bites at the cherry. So we were buying on the way down. And then from 2016, from June, surprisingly, I guess, given when Trump got in, so emerging markets actually re-rated and has outperformed. And on the way up, we started to trim. But you see that sharp decline in the in EM in the recent period. Now, what's been driving that, and this is not just true of emerging market equities, this is the same for emerging market debt, and particularly EM currencies. So I'd say if you look at the EM complex, I'd say the currencies in emerging markets have been hit the greatest. So if you look at, if we go on to the next slide and have a look at sort of what's driving that performance, and is the one I'd probably focus on is that chart on the right hand side, and it looks at flows into markets and EM and where that's coming from. So the last period, what you've had is just an absolute outflow in US. The US investors are just selling emerging markets, and you take that back to US dollars. So that is what flow is, what's driving the performance, and not necessarily reflecting fundamentals. Just sell the risk assets, get out.
So to step people through that, it's the US dollar strength. A lot of these emerging markets have got a deficit. A lot of debt in US dollars, and that's creating uncertainty for investors.
Correct. There's an element of that, and I think there's a lot of thing around, well, if you look at like global trade, so EM countries are seen as sort of global trade countries, like Korea. Yep. Is a perfect example whereby it's a bit of a bellwether for global trade, and it's probably one of the emerging markets that's been probably hit the most. So
when's that one going to be called developed? When does it?
Well, you could argue. I think it depends on who you ask.
Yeah.
But I think some providers call it developed, but we'd still probably put it in the developed, in the emerging category.
Sorry, just back on Turkey as well. So currency fell significantly. They look like they're not getting or they're not asking for support through the general mechanics of the IMF or the EU, but going with they're getting some cash injection. Was it Qatar? Are they getting some money from? And
so I think if you look at and how, I guess, in our portfolios, how not just Turkey, but how the portfolios currently have moved towards to capture some of this volatility through the international bond allocation, and specifically the emerging market component of that. So taking some of this volatility and looking through some of this noise and saying, well, there is risk here, but you're getting rewarded. Yep. So taking on a bit of EMFX, taking on a bit of the EM local currency bonds. So that's generally across the board, and I guess Turkey is a bit of a small fish, really. Absolutely. So it's not something that we would say is a huge area for us to be allocating capital. No, it's more the whole complex that we're looking at, right? And the other, moving on to slide 11, and the other issue that was sort of talked on is this disparity of growth and value, and we're very much at the asset allocation level and stock level, sort of more in the value camp. So over time, we would say that investing in value is a great way to make money, and we understand there's other ways of managing money. But in this past period, you've seen this huge divergence in the haves and have-nots. So IT, so the FANGs. So in EM, the Tencents, the Baidus, and then conversely, in that value universe, you have all the stuff at the moment that gets shunned because people like all the sexy IT stuff. So you have the boring telcos, the utilities, to a certain extent the financials. Like all these parts of the market have been ignored, and all the money is just flowing into these really sexy high tech companies who, the way they're priced is that they're going to take over the world. And whilst I think they're great businesses, I just don't think the probabilities lie that they're going to deliver long term on where their expectations are at. And I think that's the important thing, is separating what is a good business from a good investment. And I've said it a few times, that that's really, really important. That I would acknowledge Google, Facebook, Netflix, all these things are amazing businesses that have changed a lot of things, but they just, when you're on a PE of an Amazon, if you're on a PE of 250, that's a lot to live up to. And at the market level in the US, I think the last 3 reporting seasons have been over 20% earnings growth. If you bake in the valuations where they are at the moment as well, I guess the trigger for people to start switching out is another opportunity that might arise through market correction somewhere else, or its own market correction. Yeah, I think the expectations is just the big thing in my head. If you need to justify, so if you look at Amazon, so it's on a, give or take, it's on a PE of 250 or something like that. So for it to, just to give you a bit of an idea of what it needs to deliver to justify that multiple, is about 30% per annum, like out. Yeah. Which, if you look at a mature company, there's no way they're delivering that. And whilst they might hit that number, sorry, folks on the phone. So whilst they might hit that number, the law of just probabilistic wise, it's just not there. And then on the value side, the expectations imputed in those value stocks is so low that, to my point, you just need to go from terrible to bad, and then you get a re-rate.
And so I guess, and it's the same reason here in Australia as everywhere else around the world, really. The lack of yield, the pushing up into the risk appetite, and running with the momentum.
So if we flick over onto slide 12, and that segue into what I call here the feast or famine. So the two most outperforming sectors globally have been energy and IT. Energy we have like a positive view on and have had, but we've been trimming that exposure. But IT sticks out there across the board. So whether it be Australia, the US, and IT is a bit quite small, but it has done really well. Then at the other end of the spectrum, Australia particularly like Telstra's been a poor performer globally. Telcos are under a lot of pressure, so the likes of Facebook, etc., taking revenue off these guys through like WhatsApp, that text messages don't have the value that they once did. And then there's a couple of other aspects. So in Australia, you have healthcare. So whilst we think healthcare globally is a reasonably attractive space, when you think of Australia, it's a very narrow opportunity set in healthcare.
Yeah.
In terms of it's dominated by CSL.
Yeah.
And CSL is probably, if you look at a global universe, it is probably one of the most expensive healthcare stocks there is.
Okay. I was going to ask, there's a slide coming up on that one. I was going to ask there about the views. But just what struck me with this slide is the enormous, I guess, correlation with sectors wherever you are in the world. I think this chart really highlights that. What's happening here with Australian consumer staples?
So Australian consumer staples, I think there's two massive main players here. So you've got Woolworths and Wesfarmers here too. Woolies has been a bit of a turnaround story.
Yeah. Okay.
That was one of sort of a name that everyone hated. We were a bit concerned, so we didn't have a massive position in consumer staples or through Woolies through that time. But they've delivered. They had all those issues with their expansion into sort of trying to eat Bunnings as lunch, and then Woolies and then Coles has done this, right? Yeah. So it's just very, very concentrated.
Yeah.
But that's Woolies is what's embedded in there. But I think the energy thing, everything's correlated there because it's largely correlated to the oil price there, which has rebounded quite significantly.
And IT is without borders these days.
Exactly.
Good.
So I guess with that as the backdrop, we move over on to slide 14, which goes through our forward-looking expectations of returns. And to explain this chart, so the orange bars are our 10-year real return in local currency expectation of what that asset is going to deliver. So you can add inflation to that of 2.5% if you like. And then what the yellow bar indicates is effectively the change in that return looking back to the prior year. So where you want to be is in assets toward the left-hand side of this chart, and where you want to avoid or have less allocated to is assets on the right-hand side, everything else being equal. And I guess you've got your equity bucket as well as your fixed income bucket, and generally fixed income is not going to return you as much anyway. So a few things to pull out here. So I guess on the left-hand side of this chart, so what comes through pretty strong is our preference, not just is for Europe in general, and if you can get exposure within telcos, financials, and still European energy, although that return has come off substantially because of strong performance. UK equities, emerging markets, both the equities as well as the local currency debt, and Japan equities. So those are our preferred exposure. Preferred exposure is more in the equity complex. I think a couple of key things to pull out is if you go down the right-hand side of the chart, is our forward-looking expectations of US equities. Next to nothing. And I think it's probably safe to say, don't get too hung up on the numbers attached to these. It's more the relativity in terms of where we see the opportunity. So US equities to us looks extremely expensive. So underneath the bonnet of US equities, I think probably the only sector that looks still okay is healthcare. But outside of that, and particularly IT, looks very priced to perfection.
Is one way to say it. I think when we started to see this slide, you know, over the last few years, there was queries over, well, Euro Telecom, we're in an SMA here, you're not getting exposure to it, what the hell's going on? But now we're picking up a lot of those left-hand side exposures now through the mark capability, aren't we?
So I guess if we want to be,
sorry, the multi-asset real return.
Yeah. So we want to be as focused as we can get. But I think the MAR or the multi-asset real return gives us the opportunity of be as pure as we can get. Having said that, we'd still be happy to hold Europe generally, Japan generally, and UK as part of sort of iShares Europe. But if we could, we'd love to get more nuanced exposures. Just given the opportunity set, sometimes it's just not able to be.
Great.
Okay. So if we look, and that was sort of at a high level now, this slide is probably very much in contrast to the one I showed earlier around the performance of the various markets. So if you hark back to that, you remember that IT was up there in terms of its performance over the last year, was up the left-hand side. Energy was up the left-hand side. Telcos was down the bottom. Now, what this is showing is across the major markets, what the sector 10-year expected valuation implied returns are telling us. So generally, telcos looks like the most attractive sector across the board. And I think we've touched on it's fallen the most. It's been avoided because of at the expense of IT. Financials generally looks okay. I think where we would prefer to have our exposure to financials is probably outside of Australia, or outside, like we're looking at a benchmark. So we think the banking sector here looks challenged. We think Commonwealth Bank looks okay, but outside that, we'd say generally the banking sector here, which dominates that index, looks unattractive.
Can they shrink to greatness, like many are saying, divesting a lot of their wealth businesses? And
I think, well, it's an interesting. I think it's in a way it's a bit dangerous doing that.
Yeah.
So you shrink, but you also concentrate your business.
Yeah, that's right.
So it's a big bet on Aussie mortgages.
Yeah.
Healthcare, with the exclusion of Australia, looks like a good place to have money. And the way you think about it is just CFL in Australia is one of the most expensive healthcare companies in the world. It's a great business, don't get me wrong, and they have had a great track record of delivering, but we just think you're better off being in global healthcare names, which effectively are operating in the same market. So if you think of the likes of Pfizer, Johnson & Johnson, those are the names that you have exposure to through the global healthcare ETF.
And I think that speaks to Australia in general. You've called out a few stocks. You've called out Telstra for Telcom, Healthcare, CSL, Woolies and Westfarmers. So we are very single stock sensitive still. The concentration of the Australian market really throws these numbers around.
Correct.
Because it wouldn't take much for CSL to have a big correction and that one bump up to zero.
And I think that's right, is that you have to weigh up the concentration with breadth here in terms of how meaningful some of these sector VIRs are. But we'd be pushing our portfolios towards those telcos, financials, and trying to push away from IT.
Makes sense.
And then if we move over onto just quickly going over some of the activity we've had in the portfolios, and then what our current positioning is, and then some comments around what we're looking to do. So on slide 17, so this shows the over the quarter, the second quarter, what we've been doing in portfolios. And generally, I'd say these sort of mask what we've been doing underneath the bonnet. So I think if you pick out international equity, so it looks like it's decreased, it's a marginal decrease, but what's been happening under the bonnet there is in quarter two, we were fortunate that we were trimming EM assets up to the point where this market correction happened. So that is an element of us trimming as the valuation gets a bit more challenging. Since then, you'd say everything else being equal, it's probably a time to dip back into those assets. The alternatives, increasing the alternatives exposure was that multi-asset real return exposure, so upping that in the portfolios, which gives you a bit more of those niche exposures. Also increasing a bit of exposure to the international property, and I think we've probably luck more than anything. We timed adding that global REIT into the portfolio very well. In that, I think if you go back to one of those first few slides, it's probably one of the top contributors to performance over the 3 months. And then I'd say probably the one that is important, and you'd probably think, oh, that's what's happening there, is the decrease in cash and the increase in international bonds. So if you think about our portfolios and how we're positioned, so we broadly think that equity markets are expensive, but so too are bonds. So what has decreased that cash in that last quarter was that you hadn't had a point where yields started to increase, and so cash became a way which we dipped our toe back into holding more bonds. So particularly in the US, if you think of what has happened to the US 10 years, so it had gone from 280 up to 310. At that point, we were sort of happy to, at the expense of selling cash, increase allocation to international bonds. And that's not just US 10-year treasuries, it's also that emerging market complex as well. So that is the main reason why that cash has decreased. We just think marginally you're getting better rewarded for the risk you're taking in that bond space, particularly in emerging markets and sort of broad US markets.
I think due to time, we might hold off diving any deeper into the long-term US bond outlook, but there's some conjecture at the moment in how they're going to fund all their spendings. They're going to have to issue more debt. That's going to have to be at a higher price because more people are pulling out of US bonds, like sovereigns probably. So that's going to create an interesting path, but further down the track.
Yes, I think we would say that we think yields are going to increase from here. Path, who knows? And I wouldn't say that's our core competence. Long term is our core competence, and we think that the direction for yields from here is up, and as yields increase, portion of that cash which is held because bonds are expensive will be out deployed.
Great. Good.
And then this is sort of where it all comes together in terms of the growth managed account exposure at the end of June. And probably the first thing that jumps off the page is the horrible colours, but focusing in on that green number, so the cash. So it's sort of to my point that I just raised before. So when bond markets and equity markets are expensive, what do you do in that environment? You hold more cash. Why? One is dry powder for when things fall, and then you reallocate back, which is what you saw us do with that international bond exposure. But two, it's about, these are CPI plus portfolios, and it's an absolute return, and we're wanting to protect against drawdown. And I think that is really important as to why we're holding so much cash, is to protect against drawdown. And that, if I could give you a take-home message, is that's it. So it's cash is dry powder and protecting against a drawdown.
Is there a number in mind, like how what quantum are we protecting against by having the cash? Is there a number? Is there a tightish range to put you on the spot
in terms of a drawdown?
Yeah. I mean, anything could lead to it, but you feel things are expensive, both bonds and equities, to become more fairly priced. What are we talking? Are we talking about a growth investor or balanced investor losing 10%? Is it what?
It depends on, like, if you're protecting, like, who knows what that drawdown is about.
Yeah, that's right.
Probably the we just don't want to lose capital.
Yeah.
Because at the end of the day, that's what investors eat, is net returns and cash in their pocket. Mum and dad don't really care about volatility and that
performing a fall,
like standard deviation or anything like that. They care about what's in that pocket.
Yeah.
And that's what we're protecting here. Right? Risk to us is drawdown.
Yeah.
And how that links to our process is that valuation is linked to drawdown. So the more expensive an asset is, the higher there is for a bigger drawdown. And you've seen that through market cycles, in that the more expensive something is, the higher the drawdown that's probably connected to that.
Yep. No, I think that's
specifically what we're holding cash.
And it is powerful. You know, I've had a number of advisors call over the last month or so, just saying, asking what's going on and asking for some context to it all. And I think those are really powerful messages to make sure that, you know, Bryce, you and I live in it pretty much every day. The advisors most days, but they've got a lot of other things to deal with. So we need to be really clear and succinct and shout those powerful messages for those on the line to take to their clients when those questions come back. So, no, I think that's a really important one. Thank you.
And then I'll just probably make one final comment, is that when you have these bouts of volatility, in the short term, they can be painful, but they're also opportunities. So we are currently at the moment looking at allocating some of that cash. Given what's happened, you should see us when markets fall, we should be dipping our toe in and allocating some of that capital. So,
not praying for falling markets, but sort of fingers crossed. No, I know what you mean. All right, thank you. In the interest of time, we might just push through to the summary and
sure.
What you've got there, if there's anything.
Yeah, so it's just a title altogether. So from the start, so overall it has been a pretty reasonable year for financial markets, but it does mark huge significant divergence at both country, sector level. Then to my point, so 2018 for the portfolios has been challenging, and I guess there's key positions, so emerging markets being one, and a few others face short-term selling pressure, but also that brings opportunity. I think the strong US dollar has just been pervasive through everything. And that is something that I just don't think will continually persist. And that just creates, again, opportunity. And then finally, which I've sort of banged on about quite a bit, is we do retain significant cash balances in these portfolios. A, for being dry powder, and B, to protect against drawdown, which is how we view risk. And we are currently looking at allocating some capital based on these recent moves. So,
no, that's great. Strong messages. Thank you, Bryce. I'll continue on, just so anyone on the line, please ask any questions you may have remaining. Just wanted to quickly whip through the recent enhancements and key items. So we launched the VMAP's digital acceptance of applications, the fee aggregation and administration fee capping we mentioned, the Morningstar model closures happening on the 31st of August. So any money remaining in those four sectors will be moved. Super pension component visibility is now available through the VMAP system, and Centrelink schedules are now available, but we'll report that to you more formally shortly. Too early to give you any definitive on these next two, but Praemium are looking at a QROP solution and we're working with them towards that. As I said, it is too early to say anything more than that, but that also links into some non-custodial or external asset reporting. So I hope to have more good news on that for you shortly. And also, as a result of strategic refresh, we did have a few items just on pause, but those will firmly come out now, and we'll be looking at the sector range of models on VMAPs and also the direct equity international. So there's been some murmurs about the direct international equity. We had Arnhem in, a number of times. They've since closed up, so there's still a few issues in that area, not only at the managers but at the execution level, that we want to tap through, because we obviously want the optimal solution for our advice firms for their clients. So we'll keep you abreast of what we're looking at there. We hope to see you in Hanoi. I'm heading over next week, a few days early. Come and see us at the trade stand. We've got Carl Richards, the sketch guy, you may be familiar with, who's worked with Morningstar and a few other of our investment managers. Incredible guy, just simply stating very complex issues. We've also got an optional breakfast session on the final day of the conference. We've traditionally had very good attendance, so please keep that up and come and see us at the trade stand. For anything more, please reach out to your local representative or myself. We don't have any questions coming through, and that's got us right on the hour, so we'll wrap up there. Thank you very much for your time, Bryce. And just, I guess coming home with those powerful messages is so important. We'll continue to get those out to the network as well. We've just had an influx of air conditioning, so I'm not sure what's happening right here. I'm sure that's coming through the speaker. So, Bryce, thank you again.
No problem.
And thank you for all those who have dialed in. Appreciate the time, and speak soon.